This is Michelle Garcia with Windermere, and I am chatting today with Kaylee Palmer. She's a mortgage loan officer for Mountain West Bank. Say hi, Kaylee.
Hello.
Hello. So I will give all of Kaylee's information, contact info in the notes and also at the end. But we just wanted to jump into a topic today regarding financing condos. I'm a real estate agent in the northern Idaho area, specifically Coeur d'Alene, Idaho, and we have a lot of activity with condos in our area, and it's kind of a different animal sometimes as far as financing goes than a standard single-family home. So I wanted to address this topic, and Kaylee is awesome. She's been able to answer all of my questions about this, so thank you, Kaylee. And this will be posted on my site, which is CDARealestate.com, and then I'll push it out to other social like Facebook or YouTube or whatever. But you can always find any of these interviews or other information about Coeur d'Alene, Idaho at my website there, CDARealestate.com. I'm with Windermere, by the way. So, Janie, I'm going to let you introduce yourself. Just kind of give us a little quick blurb about your background and what brought you to becoming, is it loan officer, loan originator? What's your title?
Yeah, I know. People use them interchangeably, but loan officer is technically it's a mortgage loan originator, but I feel like people say a loan officer more. So either way.
Okay. Okay, so, and then tell us, you're working with Mountain West Bank. How long have you been there? What's your background?
Yeah, so I started with Mountain West about 4 years ago, and I started off, I was a loan assistant for one of our sales managers here, and I assisted her for about 3 years, and then after assisting her for a while, I went out on my own, and I've been a loan officer for now about a year. And and so, been doing that for about a year and enjoying it, and it's been really helpful having that 3 years of kind of being an assistant under her. I was able to learn a lot and kind of do the job without having to be out on my own, and so I had somebody kind of be able to teach me the ropes instead of having to just jump off the deep end on my own.
Yes,
so,
right.
So,
right,
yeah,
and I would, let me just jump in real quick and say I've done deals with you, and you are awesome. You're young, but I always tell people that I refer over to you, don't let that fool you, because you really do know your stuff. So I'm super excited to be able to get some of this info from you and for people, because I feel like all of that training you did with Marilyn, right?
Yep.
That really served you well. So I appreciate.
Yeah,
I know when I send someone over to you, you get creative. If something's not, perfectly situated in their circumstances, you try and figure out other things that might work for them. So
yeah,
that's why I love you.
We have a huge team of senior loan officers that have been doing this forever, and a management that's been doing it for a long time. And so there's a plethora of knowledge, which is really nice for us newbies because, we sometimes, we won't know something. We have so many brains to pick from that it's always, it's just so awesome having so many different people to pull. If you get something kind of weird, you've got a lot of different people to go to for advice.
That is awesome.
Maybe somebody knew something someone didn't. So yeah, it's awesome. So,
yeah. But you are holding your own. So I've done lots of. We've just had a lot of interaction. So I know that you know your stuff. So let's jump in. We're going to talk about condos. So why is financing a condo any different than a single-family home? Kind of give me a bird's eye view.
Yeah. So the biggest difference between financing a condo versus a regular home is that, like on a regular home, you're going to have to qualify. The borrower has to qualify, and they do on a condo as well. But with a condo, we actually have to approve the condo association. So you're kind of, in a way, you have a little bit more red tape to cut through, a little bit more hurdles to jump through, just because you find your condo, you get pre-qualified as a borrower, and then we have to actually get a condo questionnaire filled out by the HOA and make sure that they're going to qualify. So we look at a number of things. We look at, and we'll kind of, maybe I'll go into a little more details, further down in the interview. But there's just, most of the time with a condo, there's going to be a lot more restrictions on the complex that you're buying into, and we have to make sure all of those things are being met in order to finance that particular condo. And depending on the loan program, there's sometimes further requirements. So that's kind of the biggest thing, is that the condo association has to qualify too, not just you as the borrower. And also on a condo, you don't technically own the land that the condo sits on. So you only are going to own your actual unit. Where on a home, or on like a single-family residence, you're actually going to own the ground beneath it as well. So that's kind of the biggest difference as far as when you're looking at purchasing, a condo over a single-family home. Are those two things are usually from our side what we want to make sure that borrowers are aware of.
Right. Okay. Okay. So the land itself. Yep, that's a good point. And then, are the same loan programs available for condos as are for single-family homes? Like, I think everyone knows about FHA. Or can you kind of speak to the different loan programs available?
So technically all loan programs are available for condos. The issue comes in with that the condo complex has to be approved for government-backed loan programs, so FHA, VA, USDA. So it's hard. In our area, there really are not a lot of condo complexes that are approved FHA. FHA, which once they're approved FHA, they're good for USDA as well, and then VA has their own list. So there's more VA approved associations than there are FHA and USDA, and so most of the time, like I think in Kootenai County, there's only like 3 active government, like FHA approved associations right now. So it's not very many of them. So most of the time they're going to go conventional financing. And that all of the programs, so technically all the programs are available, but conventional, it seems to be most of the time if you're looking at a condo, you need to assume you're going to go conventional financing.
Okay. And what are the 3 associations if someone does want to try and do one of those?
Yeah, so in Kootenai County right now, we have Honeysuckle Glade in Hayden that's FHA approved, Prairie View Terrace in Post Falls, and then Pier 2201 in Post Falls is also approved. Okay.
And actually that's the one on the waterfront. That's interesting.
Yeah, I know, it is. I haven't done one recently or heard of one done recently FHA, but yeah, technically it is on the list. So
are those harder to get through than like I know with a regular single-family residence, sometimes there's more hoops you need to jump through if you do one of the government-backed loans versus the conventional. Is that kind of the same story here?
Yeah, same, okay. Exactly. It's going to have the same type of things as a single-family would, okay, on top of the fact that it's a condo and that we have to review and approve the condo as well.
Okay. Okay, so a lot of condos, we're talking North Idaho. We're really specifically talking Kootenai County is the area that I handle. So I, can't really speak to things outside of this area. But in our particular area, because we're kind of a resort town, we have a lot of vacationers, and so we have second homes, we have homes as investments, and of course there's all different types of investment, vacation/vacation homes. There's different ways the taxes are handled, and let me pause right here and just mention that none of this is legal advice. I'm not a lawyer. Kaylee's not a lawyer. We are kind of sharing what we know about this information, but every situation is individual, and anyone listening needs to just know that, you need to check with people about your specific situation. So jumping back into the topic, though, let's talk about second homes, investment. How does that change when we're talking about the financing for these? So like what types of loans or does it matter what types of loans are available for, say, a primary residence condo versus a vacation rental condo?
Yeah. So not even specific to just condos, but anytime you're purchasing something as a second home or an investment property, whether it be a condo or a single-family residence, you're only going to be able to go conventional financing. So FHA, USDA, VA, those are all primary home purchases only. So just just wanted to mention that.
Sure.
So with a condo, conventional financing is going to be your only option for that. And along with that, a big kind of a difference between purchasing a condo as a primary residence versus purchasing it as an investment or a second home is the scrutiny that we have to put on the homeowners association condo questionnaire that they fill out. We have to look at it a lot more in detail, and so a lot more comes up. So basically, the only way to get around this condo questionnaire that basically approves the condo association is that we either have to do a full review or we have to do a limited review. The only way to get around the full review is to put 20% down going conventional as a primary residence. If you are putting less than 20% down, we have to do a full review. If you're purchasing it as a secondary home or an investment, we also have to do a full review. So what that means to you as the consumer is when we're looking at a full review, there's more things that are required. We have to confirm that the condo association has at least 51% of the units owner occupied, so they can't be rented out. There has to be less than 35% of the building used as commercial space. We also have to get a copy of the condo's budget and confirm that they are obviously sticking to their budget and that they have 2 months reserves or 2 months cushion in their budget. And then the other thing is that no single entity can own more than 20% of the project for units for complexes that have more than 21 units. If they have less than 21 units, that is dropped down to a 10% maximum for single owner, for one owner to own more than that percentage. So
interesting. That's a lot of rules.
A lot of rules. Yeah, it is, and that's why purchasing a condo becomes so complex because I would not say the majority of people are putting 20% down when they're purchasing a condo as even if you are putting 20% down, if you're not purchasing it as a primary residence, you're still kicked into that bucket of having to do a full review. So the beauty of purchasing it as a primary and putting 20% down is you get the limited review, which basically doesn't address any of those topics. It basically is, it's very much none of those things that came up on the full review come up on the limited review. The limited is a lot easier, a lot more streamlined. So when you're getting into that full review, you're opening up a lot more potential issues that could create something to go sideways.
Well, you bring up an interesting point, though, with this looking at their budget, and because some of these are kind of safeguards, right? So, obviously the bank is looking into their long-term financial interest and making sure that as little risk as possible. But even if someone's purchasing a condo with cash, that is kind of an issue, right? To make sure that the association is sound and operating.
Yeah, because they don't want to, I've had a couple people that have said, oh my gosh, I purchased a condo and, there was issues that I didn't know about and my HOA dues went up, by a couple $100 a month or whatever it is, which happens if they're under budget. And then they look and they say, oh, well, shoot, we don't have enough budgeted and we need a new roof. And so we're going to have to up everybody's HOA dues. So it is to protect us as the bank, but also the customer, so that they know, that they're buying into a condo complex that is financially secure and that things look good, and we do our due diligence to protect both the bank and of course the borrower.
Right. Well, and that's good. Now go back to what was the percentage for the commercial space, and how does that apply to one of our big developments here is called Riverstone. There's quite a few condos in there, and of course there's commercial space mixed with residential. So how does that apply?
Yeah, so that number was 35%. 35% or less has to be commercial, and that the Riverstone condos are less than 35%. They kind of went back and forth, and it's kind of hard because, you know, somebody filling out the HOA questionnaire is putting these numbers down, and so the numbers a lot of time, we've had at one point we had like 3 condos in Riverstone that we were trying to finance, and 3 different condo questionnaires that all had different amounts for that commercial space. So we're like, okay, so, you know, so it's definitely an area where...
Who's answering those questions, the buyer or the...
Nope, the HOA contact. So whoever is like the president of the HOA, the homeowners association. Or
okay.
Usually it seems to be that a lot of times it's like a property management company that will be in charge of that, you know, for the complex. They'll have that property management company do that. So they'll fill it out. And I don't know if it's, and you know, it could be too with Riverstone because it's a newer, you know, there's a lot of new stuff going in down there. Maybe it's been changing a lot too. So then at one point it was 50% and now it's 20, you know, or whatever. It's been changing. So, you know, we have to update. But as of now, we have financed a couple condos in there, and you know, they are under 35% right now at this moment. But again, things change and all that. But yeah.
Okay. So again, a lot of condos are purchased for investment. So talk about financing an investment property condo, please.
So, yep.
My daughter always makes me say please.
Perfect. So, same thing is going to apply for an investment. Although, like as I was saying, as a primary, putting less than 20% down or buying it as a second home, as far as the full review, typically you're going to want to put 20% down. We can do 15% down, but you know, then you have mortgage insurance if you're doing less than 20. So 20% down, and you know, basically the same thing. You can only go conventional financing. The government options aren't available, and trying to think. Yeah, it's pretty similar. Just to it's you know, as far as once the condo is approved and we meet all of those, you know, all of those requirements by the condo questionnaire, that full review, it's similar. It's pretty similar to just a regular, you know,
just a regular loan,
family, regular investment purchase. Yeah.
Okay. Okay. So basically 20% down and or
more.
And
then, you know, they like to 20% down or more, and then, you know, the 6 months reserves is pretty standard for an investment property. You like to see that you have some reserves in the bank, which reserves are basically, you know, whatever 6 months reserves would be 6 months worth of whatever that payment was. They like to see that in the bank. Things like that. One thing that's kind of cool on investment properties is that you can use the rental income. Like if you're going to be renting it out, you can use the rental income of what you would be getting on the rental property to qualify. So that can kind of help. That's kind of a cool thing that you can do. So if you have a rental,
now that's awesome. Are there restrictions though on how often or how little you stay in the property for your own use?
So again, this is.
I mean, I know again going into tax things, and I know. You know, we'll kind of defer to everyone needs to check with their own financial advisors, but in general, does that make any difference on the financing side of things?
So not really on the. So basically, what I was going to say again, this is kind of applies to everything, not just condos. But when you're purchasing something as a primary residence, it's expected that your intention is to live there as such, as a primary residence, not, you know, buying it as a primary and then renting it out. Life happens, obviously. If you buy something and your intention was to live there, and then, you know, say you got a job in a different state and you had to move, and so you turned that into an investment property, that happens, and that's a legitimate reason. A legitimate reason that would happen.
But if you're going in knowing it's going to be an investment property, does it matter?
So on the financing side, no. If you are going in to finance it and you want to turn it into a vacation rental, you know, type thing, that is fine. We don't care as far as the financing side goes, but you do have to watch out because most associations will have rules on that, and that's specific to whatever condo complex you buy into.
Gotcha.
So that would be something good if you're thinking that when you're buying one, to check with them on that to find out if that's even allowable, because they may or may not let you do that.
Right. Right. And so anytime someone's buying a condo, they need to look at the CCNRs, they need to look at all the rules, and the HOA usually, we're using a lot of acronyms. CCNRs are your restrictions, basically, and covenants, your all the rules that apply. The HOA is your homeowners association. You have a fee, usually monthly, sometimes quarterly or whatever, but there's a fee that you pay, and you need to understand what you get for that fee and what's covered, what's not. We'll talk about insurance in a minute, but back to the investment property question, what about not investment, but just as a second home? Does that change things as far as the financing goes?
So on the financing side, you can, if it's being purchased as a second home, typically you can do just 10% down. So it's a little bit less of a down payment requirement. And they're usually a little bit, they're not as strict on the reserve. So, you can, and obviously you can't use rental income on that. If you're buying it as a second home, they're assuming you're going to live there. You're not renting it out again. So a little bit less down, and the interest rates are actually a little bit better on a second home than they are on an investment property. They're a little more they're a little more comparative to a primary purchase. So.
Okay. Yeah. Okay, and is there any distinction as far as the financing goes with short-term rentals versus long-term rentals? There's such a big trend now, right, with Airbnb and VRBO and all the different, there's so many different websites where you can do, one-day rentals or weekend rentals. And again, the association will have its own rules, which anyone purchasing a condo needs to understand. But as far as financing, does it matter to you guys?
No, not necessarily. Again, it just kind of comes back to, like, if you purchased it as an investment property, then we're assuming you're going to use it as such, and then you're just required to abide by the rules of the HOA association, the homeowners association.
Yeah. Okay.
If you're purchasing it as a second home, though, technically you shouldn't be renting it out. And
right.
Again, it kind of comes down to that. Got to use your own discretion, because if your intention is that you're going to be renting this out most of the time, then it should be financed as an investment property. If your intention is that you're going to use this as a second home and maybe rent it out here and there, then that's fine. So it kind of comes back to that, and it's kind of a gray area of your intention with the property to start. And so the only piece of it that we really need to know about is if it's being purchased as a primary, second home, or an investment. And then we don't do a bunch of follow-up to see what you're doing with it. But
yeah. And on a separate note, I think as far as taxes go, you're taxed differently based on whether it's your own personal residence. I think it's something like 14 days or less that you rent it out. It's taxed differently than if it were, if it's more than 14 days, and that's in a whole year, then it's kind of income, right? So again, check with, and things change over time, right? So we're going to talk about rates later, and just know that anyone listening to this, right now we're recording this in 2018, fall of 2018, but if you're listening, things could possibly change. So always check with your own financial advisors first. So let me move on to insurance. So what do you guys, being the bank, what is the what do you want to see as far as insurance goes for condos, and is it any different than a single-family home?
Yeah, so this is kind of one advantage of a condo, or one of the advantages. The insurance on a condo, because you don't own the ground or the exterior of the building, you're only required to get insurance from the walls in. So the policy can be a little bit cheaper because you're not covering as much. So when we get the condo questionnaire that I was mentioning earlier, we actually also get a copy of their master insurance policy and make sure that there's sufficient coverage to cover, all of the community areas and the exterior, the roof, all of that type of stuff. We make sure that the condo has the condo association has that in place. But then, yeah, as far as the borrower, the buyer, they are just responsible for getting insurance to cover the walls in part, which, again, can be a little bit cheaper, which is kind of nice. So,
okay.
Yeah.
Awesome. Okay, and what about townhomes? Some of these terms are kind of thrown around interchangeably, and they are really kind of different. So what's the difference from a condo versus a townhome versus, I mean, obviously a single-family home, we know what that is, but can you speak to the other two?
Yeah. Yeah, because, condos and townhomes are definitely, I feel like, especially up here, there are condos that look like a townhome or vice versa. So the biggest difference is, and it's the county who really deems which it is, and it really does matter on the financing side of things, just because, if you think you're buying a townhome and then you find out it's a condo and realize you have all these extra, rules to abide by, or we have to get this questionnaire, it can, you'd like to know that up front if you can. So it is important to know the difference. So the biggest difference is that a townhome, you do have a vested interest in the land. So you have ownership interest in that land where your home sits, where, like I was saying earlier, on a condo you don't. You don't have any interest in the land, that you just own your unit, and the condo association has the ground. So that's the biggest thing. And again, a townhome, so with that, a townhome, we don't have to get an association questionnaire and all that figured out, and there's not all those rules that you have to abide by, because you own, it's a lot more like a single-family residence. You own the actual home and the actual groundwork. So, if your next-door neighbor doesn't pay their mortgage, it's not really going to impact you as much as it would if you're in a condo and someone, doesn't pay the mortgage on the condo building. That's going to be a bigger issue. So,
Okay. What about? So we're going to talk about rates. I promised to do that, but again, this changes obviously daily. So if someone's listening, like in a few months or in a few years, it'll be different. But can you speak? What are rates running right now, and are they different for condos?
So rates right now and they are different than condos. Condos are typically a little bit higher, usually about an eighth higher on a conventional loan. So right now on a conventional loan, and again, depending on the loan program and all that, things are a little different. But speaking just for, most people are quoting a 30-year conventional loan, we're at about 4.75, which is about a 4.95 APR. For just a conventional single-family 30-year loan. And on a condo, like I was saying, it's about an eighth higher, so you're at about 4.875 with about a 5.1 APR on that. So
okay, and is that for primary?
Yes, yep. Primary
and
home.
Is it more for investment?
It would be a little bit more for an investment, yep. Yeah, a little bit higher on an investment. And that's, again, whether it be a condo or any other property, if you're doing an investment, the rate's going to be a little bit more.
And what about credit, and just kind of give a bird's eye view of what people need to know when they're going for a loan, whether it's a condo or whatever it is? Yeah.
So as far as credit score goes, for conventional financing, you're going to be at a 620 minimum on our conventional loans. FHA, we don't have there's not like a hard and fast minimum on FHA, but typically around the 580 is where, about the lower side of where we want to see it. USDA, you're right about that 620 mark as well. And VA about the same. So we basically, let me double check on the VA, and I'll follow up with you on that, because that could be a little bit lower. But conventional is 620 is kind of the minimum we can go there, and it's the same for if you're purchasing a condo versus if you're purchasing a single family residence, and your rate is going to be affected by that score too. So the better your credit score is, the better interest rate you're going to get.
Right. So if your credit score is great, and you're going to maybe see some of the rates you just mentioned, whereas if you're kind of nearing that minimum, it'll likely be higher. Is that
exactly? Yep. Yeah,
ballpark?
the rates, I should
Okay.
say that the rates that I just quoted, the 4.75, 4.875 on the condo, that is going to be based off a 740 or higher credit score.
Gotcha. Okay. Okay. Well, good to know. What else? Anything I missed?
I don't think so. I think it's just, the biggest thing is just when you're looking at a condo, just, especially if you're approved for government financing, I can't stress that enough. Make sure that if you know you have to go FHA, make sure that when you're looking at a condo that you are, doing your due diligence beforehand and make sure that the association's approved, because it's nothing worse than having somebody bring in a purchase contract and they have a condo that they're all excited about, and then we find out it's not even on the FHA approved list.
Right. Or just
like, oh, no.
try and figure out how to just be a little safer and go conventional, right?
Yeah, exactly. Find out if that's an option, and so just kind of knowing, and working with your agent to kind of help you find that. And it is updated. The list does get updated, and new condo complexes become available for FHA financing and things like that. So you can just check with your lender, and we can always, see if there's what complexes are and let you know which ones to be looking at.
Well, and if there's only 3 in our area, it's kind of, there's dozens of condo complexes, so it's not likely that they will be approved. So if they go with conventional and they have a decent down payment, as you mentioned before, and good credit and so on and so forth.
Yeah, and the down payment, we have had, condos that have gone conventional. We can work with Idaho Housing and do as little as 0.5% down.
Mm-hmm.
So, that is, the down payment isn't as, if you can go conventional, we can really still get down payment assistance and all that for condos. And
oh, you can? Okay, wait. So that is through a government program, though. So would that have to be one of the 3 complexes, or could that be any?
No, so technically Idaho Housing is a state program, so it's not going to be the same thing as like an FHA or USDA. So we can actually just do a conventional loan paired with Idaho Housing.
Mm-hmm.
So you're still getting a conventional loan, but we're just utilizing the down payment assistance from Idaho Housing to do the 2.5% down payment, so you only have to bring in the 0.5% or the 1% if you have to go FHA. So you could do a condo conventionally and put a 0.5% down and utilize Idaho Housing and still be buying a non-FHA approved condo.
But that has to only. I'm sorry, I cut you off. Go ahead.
Oh, that was just saying that if you are looking at that's for conventional condos. So.
Gotcha. But that scenario would only apply for primary residence, right?
Correct. Yes.
Okay. Well, that's good to know, though. That's actually, I didn't realize that. I just figured that didn't apply.
You can do that.
Awesome. I just learned something. Yay. This is why I love Kaylee so much. Okay, Kaylee, tell people how to get in touch with you if they need more information. And also, I want to mention, even if you don't think you're going to do something right now, I like to have people talk to you to kind of get a game plan going. I just sent someone over to you. Their game plan is like 3 years down the road, but now they know what they need to do because you kind of rolled through the different scenarios for them and helped them to make a decision on how much they need to save and whatever. So anyway, how can people get in touch with you and how can you help them?
Yes, so you can call me on my cell phone, which is 208-691-0315, or you can email me, and my email is kpalmer, KPALMER, at mountainwestbank.com, and all spelled out nice and long like that.
Perfect. Okay, and do they need to worry about you pulling credit if you're, going to be able to speak to their situation? Do you have to pull their credit or?
No, I have a lot of people come in that just have questions and they just want to run through some scenarios and kind of see where they're at, and we do that, and I don't have to pull credit. No, not at all. We can just kind of talk through some scenarios and see.
Okay, perfect. Oh, one last question I just realized. Do we have to worry about the price of the condo? Are there different I should have asked you that before. Are there different limits on the different programs? Yeah.
So nothing different. Again, the condo is just going to be like a single family where we're capped at that $454,100 for the conforming loan limit. So for conventional financing, that's the loan limit, and then you end up in jumbo land, and then you're on a jumbo loan, and there's a few more, more reserves required. The interest rate can be a little bit more. Just kind of you end up, in that you're no longer on a conforming loan, and then same limits with if you're doing FHA. The $275 loan limit is going to apply, and so there's nothing. And I'm sorry, the FHA loan limit, I believe, it's actually $295. So let me correct that, $295.
And again, these can change over time, right?
Yeah, they can.
Yes.
They actually just changed recently, which is why I've left the old one in my head.
Okay.
But so yeah, just the same loan limits and income limits for Idaho Housing. The income limit for Idaho Housing actually just went up to $110,000 from $90,000, so that went up, which is awesome. But yeah, so nothing additional for condos than there would be for for the other programs on a single family.
Okay, all right. And you just pulled all that off the top of your head, which I knew you would know that. All right, girl. Well, thank you so much. I really appreciate it. If you have anyone listening, you have more questions, get in touch with Kaylee. You can also feel free to share this. I'm going to do audio and video, so you can share it. And you can also find other interviews at lakecdarealestate.com. I'm Michelle Garcia signing off. Thank you so much. Bye, Kaylee.
Thank you. Bye-bye.